When you hear the word risk in investing, what's the very first thing that pops into your head? For most of us, right, it's a stock chart, just plunging downwards. But what if the biggest threat to your money isn't the market at all? Today, we're going to dig into the 3 fundamental risks of investing. And you might be pretty surprised to learn that the one we see on the news every single night, well, it isn't the most dangerous one. The legendary Warren Buffett, he just framed it perfectly. Risk isn't just some big, scary force out there that we have to deal with. No, it's deeply tied to our own knowledge and, more importantly, our own actions. And that simple idea, it changes everything. And hey, that's totally understandable. We see it every single day. The news is breathlessly reporting every little rise and every little fall. It's visible, it feels tangible, and it really seems like it's the main event. And that is the absolute key. The risks that do the most real, lasting damage, they aren't on some chart. They're the hidden forces that mess with our decisions when the pressure is really on. So today, we're going to pull back that curtain.
Okay, so first, let's just talk about the one we all know so well, the ups and downs of the market itself. This is market risk.
Look, market risk is just a fundamental part of investing. It's kind of the price you pay for the potential to grow your money. But history shows us that while these market downturns are, unavoidable, they're also cyclical. The key variable here is time. Markets have, historically, always recovered. This risk, it tests our patience more than anything else.
So, market risk tests our patience. Got it. But now let's move on to the second, and I'd argue far more dangerous risk. See, this one doesn't live in the market. It actually lives inside of us. This is emotional risk.
This is the silent destroyer. Think about it. 2 investors can own the exact same investment, go through the exact same market drop, and end up with wildly different results. The difference isn't the market. It's their emotional reaction to it. So, what is going on inside our brains? Well, the science behind our panic is actually pretty fascinating. Deep inside our brain is this little thing called the amygdala. It's our ancient fight-or-flight trigger. So when we sense danger, like, say, a sudden market crash, it can literally hijack our brain, completely bypassing the part that's responsible for logical, long-term thinking.
Think of it like this, an internal battle. On one side, you've got your prefrontal cortex, kind of the CEO of your brain, calmly focused on your long-term plan. But on the other side, you have the amygdala just screaming, get out now. And when the amygdala wins that fight, we get panic selling.
And this hijack, it leads directly to that classic emotional roller coaster of investing. We feel like a total genius when things are going up. That's euphoria. Then, as things turn, comes the anxiety and the denial. And finally, right at the point of maximum financial opportunity, the hijack is complete. It leads to panic and selling at the absolute worst possible time.
And the fuel for this whole fire is a cognitive bias called loss aversion. Psychologically, the pain of losing $1,000 just feels so much worse than the joy of gaining $1,000. It's wild. Research from the NIH even found that patients with damage to their amygdala, they don't experience loss aversion. Their fear center is basically offline. But for the rest of us, this bias is incredibly powerful and incredibly costly.
But just how costly are we talking? Okay, imagine this. You invested $1 million in the S&P 500 for 30 years. It would have grown to over $20 million. But if you let your emotions take over and you miss just the 10 best days during that entire period, probably by panic selling, your final amount would be this much less, almost $14 million. That is the staggering price of emotional risk.
So we've seen that emotional risk is the ultimate test of our discipline. And that brings us to our third risk. This one's a structural one. And it often feels really smart right up until the moment it completely fails. It's called concentration risk.
This is the classic all your eggs in one basket problem. It's the risk that pops up when your portfolio's fate is tied way too closely to one single thing, one stock, one industry, one country. What you're doing is creating a fragile system with a single point of failure.
A really recent and painful example of this was the collapse of Silicon Valley Bank. They had concentration everywhere. Their clients were all concentrated in tech, their deposits came from tech, and their investments were all concentrated in long-term bonds. So when one thing went wrong, rising interest rates, this triple concentration created a totally fatal single point of failure.
And this isn't just about stocks either. Concentration risk hides everywhere. Vendor risk is like a restaurant that relies on a single farm for all of its produce. Industry risk is like having your entire net worth tied up in typewriter stocks in 1985. Geographic risk? That's owning a bunch of rental properties all on the same street that gets hit by a flood. These single points of failure can be anywhere.
Now, the real danger here is that these risks, they don't operate in isolation. Oh no, they feed on each other in a predictable and pretty destructive way.
It's like a domino effect. First, market risk hits. Just a normal cyclical downturn. But if you have concentration risk, that loss is dramatically magnified. Your portfolio falls much, much more than the overall market. Then that magnified loss triggers emotional risk. The amygdala hijack kicks in, and you panic, selling at the absolute bottom, locking in a devastating, permanent loss.
Okay, this might all sound a little bleak, I get it. But here's the really good news. Of these 3 risks, 2 of them are almost entirely within our control. The key to success isn't trying to avoid risk, it's about focusing your energy on the parts you can actually manage. You cannot control the market, you can't control the economy, and you certainly can't control the news headlines. Trying to is just a recipe for frustration. But you absolutely can control your plan. You can control your portfolio structure through diversification. And most importantly, you can control your own behavior by setting up rules-based systems before a crisis hits. This is where the game is truly won or lost.
So we really need to redefine risk. It's not a temporary drop in your portfolio's value on a screen. True risk is making a permanent, irreversible decision, like selling in a panic, and losing the discipline of your long-term plan when it matters the most.
And this leads us to a risk-aware mindset. It's a shift from trying to avoid risk to managing it intelligently. An investor with this mindset expects markets to be volatile. They plan for emotional stress by literally writing down what they'll do during a downturn before it ever happens. They deliberately limit concentration by setting rules, like making sure no single investment makes up more than, say, 5% of their total portfolio. They don't avoid risk, they design for it.
And this, right here, provides a final, really clear summary of everything we've talked about. Market risk is ultimately a test of your patience. Can you just wait out the storm? Concentration risk, well, that's a test of your portfolio's structure. Is it robust or is it fragile? And emotional risk, that's the ultimate test of your personal discipline.
So I'll just leave you with this. The real danger has never been a market correction. It has always been our reaction to it. It's about losing our cool right when our future depends on us keeping it. The question isn't, will the market fall? The real question is, are you prepared for when it does?